Jean-François, welcome to Hub Dialogues.
It's a pleasure to be on, Theo.
Just, people might be wondering what a chief economist at a major bank actually does. Just for those who might be curious to kind of really understand what exactly you do, can you just kind of walk us through what a chief economist at a Canadian major bank does?
Well, we do a bunch of stuff. And, believe it or not, forecasting is probably takes up a reasonably small part of our time. And obviously, we spend a lot of time thinking about what's going to happen in the world, whether it's an economic thing or an interest rate or currency dimension. But most of our time is spent talking with clients, trying to help them understand the world in which they're operating, the world in which we're operating. Sometimes for those conversations, point estimates matter. What's growth going to be next year, next quarter, those kinds of things. For capital markets clients, it's very much conversations about interest rates and exchange rates, so things that they can trade on. But from my perspective, I'd say the majority of the client talks that I do are, helping businesses and individuals make the best decisions possible given the information set that's out there. So it's about providing that perspective, helping people make sense of the world to the extent that you can make sense of the world. And that's a big part of our job. And then the rest is, obviously managing a team because we're chief economists. So we have folks reporting into us, but feeding into broader things that the bank is doing. So, asset liability committees for some individuals, um, helping on, preparing speeches for the CEO, representing the bank in various forums. It's a broad range of things, but I'd say the majority of the time spent is just trying to help our clients make the best decisions they possibly can.
Right. So, I mean, we're in a kind of a weird time right now, lots of uncertainty out there. What exactly are the clients asking right now? What is their number one question? And how are you, what advice are you telling them?
Well, they're asking the right question, and it's an impossible question, which is what is President Trump going to do? Because the reality is that as much as we have concerns or not about what's going on in Canada, whether it's regionally, sector specific, or nationally, we are at a point in our history where the actions and decisions taken by President Trump have much more bearing on where things go from here, for markets, for Canada, for the US, for the rest of the world than we're used to. And the challenge with that is it's not at all clear to us, to you, to business people, investors, again in Canada, elsewhere, where President Trump is trying to go with these things, and is he going to be kind of structured in his approach to delivering on those things. And what we've seen so far, of course, is that's not the case. Lots of questions about the motivations behind his trade policies, lots of questions as to whether or not this is sustainable, lots of questions as to what he's trying to achieve and how do you negotiate with an individual like that. Lots of questions as to the uncertainty this creates and how you manage that uncertainty as you await to see where we land on various things. And it's those kinds of questions that keep people up at night. Might lose my job because the tariffs are going to be so painful that Canadian businesses are going to terminate individuals. If you're a business, like, do I invest? Do I take a lot of imports? Do I, slow things down until I get a better sense of where things are going? And that's largely what businesses are doing. But it all boils down to trying to get a perspective on what the president is trying to achieve and how he will do so, and whether or not he um, will, adopt a course of action that is less confrontational, less aggressive than what he has been doing over several weeks.
Yeah. And given the inherent unpredictability of Trump, what are you telling clients? Like what advice would you give not just your clients, anyone at this time in terms of,
Yeah.
what the outlook looks like?
Well, so I come back to the first Trump administration, where you may recall President Trump campaigned at the time on immigration, a lot of Mexico stuff, and on NAFTA, and basically argued that NAFTA was a horrible trade deal that needed to be ripped up. So when he took power in Canada, much more so than other parts of the world, because we were directly targeted by this in Mexico too, there's existential angst at that time as well. Huge increase in uncertainty. Would we have a trade deal with the Americans or not? Is he going to rip it up? Do we have to rethink our trading relationship. We have to rethink our industrial strategy. So it was a period of intense uncertainty for Canadians in particular. Now, at the end of the day, that got negotiated. It was extremely challenging for a while, but NAFTA was renegotiated, and it's now CUSMA. And that deal is, by and large, what we had in NAFTA, with just a few little tweaks here and there, that satisfied the president's desires. And then he turned around and said that was the best trade deal essentially in the history of trade deals, or something like that. So we tend to forget that episode because that's emblematic of a couple of things. One, at the end of the day, it was pretty easy to get President Trump to agree on a course of action that wasn't nearly as damaging as what we feared. But two, and this is maybe the more important thing, is that we looked at the 4 years of the Trump administration and how Canada performed, how the US performed, how the global economy performed, and we all did fine. But in those first few months, it was extremely worrisome. And we're kind of on that track now. Obviously, the stakes are bigger because it's a much more aggressive trade policy and a much broader, but it is deeply uncertain. We hope that it won't take all that much for President Trump to, say that he's gotten major concessions out of countries. That is his trademark. He will characterize any give on the part of a negotiation as a major accomplishment on his part, and that's fine. So we hope that that's kind of what happens in the next few months, is that as pressures put on the U.S. economy as a result of this tariffs uncertainty, as businesses put pressure, as countries approach and negotiate, to the extent that that's possible, as the mounting costs of the tariffs and the uncertainty are evident from a political perspective in the U.S., that he looks for off ramps, that he looks for a more rational outcome, and we hope that that's where we land. So not to over-index on the fear currently, because there is plenty of reason to be fearful, but to assume that or to hope, maybe more than assume, that there will be some rationality as we go forward and a de-escalation relative to where we are now, and perhaps a very different investment landscape 6 months from now than we're currently experiencing. Now that's a hope. That's a hope, and it assumes, and this is part of the challenge, it assumes that President Trump approaches some of these decisions with some degree of rationality relative to kind of economics and finance.
Does that manifest in some type of assumption you're making around effective tariff rates? Where are you kind of in short or longer term in terms of what?
So as we think through our forecast, we assume that everything is permanent. If he says I'm doing this, we're putting that in. And it's a choice. Obviously, it's part of the challenge in forecasting in this environment. Do you assume that he says what he's going to do? Do you assume that he's going to unwind it at some point in time? We don't know that he's going to unwind. We don't know that he's going to keep him permanent. But for the moment, we're putting permanent in, or at least we're putting his policies in place in our models and letting those run through. So in a sense, the forecasts that us and others are doing that assume these things have got lots of run to them are probably worst case scenarios. At least we hope so. But it's a choice between that and picking an arbitrary date at which these things might get unwound and having some challenges there. But there's no.
But you're not assuming any escalation of the effective tariff rate, because
No.
Canada right now has a relatively lower effective tariff rate than most other countries. It's largely, we've kind of been spared those economy-wide tariffs that, other countries are facing. It's largely sector specific. Economists have forecast or projected kind of those, or estimated rather, those tariff rates at somewhere around 5%, I don't know, 5 to 7% or so. Are you assuming that's kind of where they stay?
For Canada, yeah. We assume that. I mean, we're assuming that until presumably there's going to be renegotiation of CUSMA at some point in time. And then if that happens and things change, then we'll reflect that. For the time being, again, President Trump is not indicating any desire to move back from where he is. We think maybe circumstances will force that to happen at some point in time. But it also seems clear, at least we hope, maybe not so clear, maybe again, it's another hope, that Canada is to some extent put on the back burner now. Clearly, the major challenge is China. He's negotiating with God knows how many other countries in the short run to with these reciprocal tariff issues. Um, we're hopeful and reasonably confident that we won't see an escalation against Canada in particular as we go forward, and maybe some scope for de-escalation again as we go forward a little bit. Certainly, there's no point negotiating a free trade deal if at the end of the day, you've got willy-nilly tariffs on various things. So the fact that they've indicated some willingness to renegotiate CUSMA is also another indication that maybe as we go forward, we can look to a world where the tariffs are lower than they are now. But that is not what he's indicating. And in fact, he can't really indicate that anyways, because he can't, if you think of this as, from his perspective, he wants to negotiate against a broad range of countries, he needs to be able to say that what I'm doing is permanent. And there's nothing you can do that's going to move me off that, because in his mind, that gives him negotiating leverage. So it may not seem like he's willing to back off, but it just, you put two and two together, the economic consequences of this for Canada, for the US, whether it's with respect to our tariffs or broader tariffs. You put this with, the cost that will be clear for the American economy in terms of, purchasing power, in terms of industrial activity. And then you link in the political side of this, which is there are midterm elections in 18 months or so, at which time, a lot of this needs to be behind President Trump if he is hoping to maintain a Republican majority in Congress. So the stars kind of look like they're aligning to less tariffs at some point in time, but we're just not banking on that for Canada or other countries.
Yeah. So what does that mean exactly for your kind of forecast for growth? I mean, I know it's a tough time for any economist to kind of have a lot of confidence in projections, but broadly speaking, are you seeing a slowdown in the Canadian economy? Are you worried about recession? Like where does Scotiabank sit on kind of broadly on the growth outlook?
All the above. I mean, there's no question the economy is slowing. You would expect it to, not only because of the impact of tariffs, but also because of the impact of the uncertainty that we're dealing with, right? If you don't know what kind of operating environment you're going to be in from a corporate or household perspective, you behave differently. And we're seeing that. No question, we're seeing that in Canada. We're seeing maybe more of that in the US, to be honest, at this point in time. So as we think of the tariffs in Canada, we estimate them in the 3.5 to 4% range. I mean, there are all kinds of estimates you got to make for that. And tariffs at those levels, probably aren't recessionary. Lower growth for sure, but they're not a death blow to Canada. Where we're increasingly concerned in terms of growth dynamics in Canada is a shock coming from the United States. Because what the United States is doing to itself is far more significant than what they're doing to us, right? So if you think of the average tariff in the U.S., was around 2% prior to President Trump coming into office, and are now in the 26, 27, 28% world, depending on how you measure these things. The highest level in 100 years. That is unquestionably going to be a major shock to the US economy, both in terms of the impact of tariffs, but the uncertainty of those things as well. And then you've got other kind of, Doge related things and various things that are impacting confidence in the US at the same time. And that puts you in a world where you're probably marking down. In fact, we are marking down our US growth forecasts much more significantly than we're marking down our Canadian forecasts. And as we kind of evolve, say the last couple of months, the source of the negative revision to our outlook in Canada is weaker US growth as opposed to tariffs, which, by some stroke of luck, the assumptions that we had for Canadian tariffs going back to December have kind of worked out in terms of where things are landing. So it's really this kind of more traditional than demand shock that you're facing for the US. The US is going to be weaker. Of course, that impacts Canada as much as we want to diversify. Still very significant trading partner for us. And you get, you probably, well, you're flirting with a recession in the US, flirting with a recession in Canada because of the US. Now, the one imponderable in that circumstance, which is more of a Canadian issue than a US issue, is how do policymakers respond to the threat of a recession or to the slowdown that we're experiencing. And there, in our forecast, we will assume that there's a fiscal stimulus plan of some sort. Not a big one, maybe a percentage point of GDP, split between transfers and government, investment spending at some point in time. Just enough to, stabilize the economy a little bit. Still experience a slowdown to maybe a half a percentage point next year or something like that. But that would be lower if the government weren't in a position to offset some of that shock. And then, which is, an important role the governments are going to play, and both parties are speaking about this. I mean, it's clear that this is going to happen if we need it. Whereas when you think of it from the U.S. perspective, as it impacts Canada, they are definitely not in the space where they're thinking about fiscal stimulus because they believe this is short-term pain that's going to generate long-term gain. So there's no point in trying to offset some of the weakness in the short run. In fact, they want to crunch a deficit down south.
Yeah.
So in that sense, Canada is a little bit advantage in dealing with this because the nature of the shock is a little bit less dramatic than the Americans imposing on themselves, and we've got more policy flexibility to deal with it because we're going to be responding to the shock as opposed to creating the shock.
Mhm. So if we get dragged into a recession, it's because the U.S. is pulling us into a recession. Do you think that there's any a high chance of a deep recession? I mean, it sounds like that if we do have a downturn, it will be a mild downturn, maybe a mild recession. No one actually is really predicting any major downturn in the Canadian economy or a deep recession. I guess deep recessions are tough to predict anyways to start with. But I mean, if you could assign a probability to kind of a large downturn, let's say something like in 2008, 2009 recession or some large recession like that, what's the likelihood of something like that happening?
Like it is um, not unlikely. I mean, oh, sorry, it's unlikely, but it's not. It's not a tail scenario.
Yeah.
And the big challenge there is it comes back to what President Trump is trying to achieve. Right, the worst case scenario for the global economy at this point in time, and that includes Canada, is you end up in a series of escalating tariffs. Right, that the Americans have put the tariff proposals they've got in place. Countries don't like being tariffed like that, being treated that way, so they retaliate, which we see in the Chinese do very, very aggressively. And you're already seeing there, unbelievable tariffs, 145% of Chinese exports into the US now. They were 54% a week ago. And that's that kind of escalating impact. Now, he's negotiating with a range of other countries, but it's quite possible that as those negotiations take shape, that countries get upset and retaliate to those tariffs as well. And then you end up in retaliatory tariffs outside of the China-U.S. angle. And that brings the world to a world where you have these, much higher tariffs than what are currently being priced into markets. And of course, any history buff out there will know that part of the reason we tripped into the Great Depression in the 30s was these escalating tariffs that led to a very significant increase in inflation across a broad range of countries that led to a very significant decline in trading volumes, which made our economies vulnerable to what happened. So we're not like we're not there yet, but you can see how easily one could trip into these kinds of scenarios if um, if President Trump is obstinate in his pursuit and other countries are aggressive in the defense of their own interests.
Mm. Canada has also imposed retaliatory tariffs. In fact, I mean, next to China, Canada has actually been more aggressive, well, let's say compared to Mexico or the EU, for example. I mean, there's a good reason why you could argue that you need to impose retaliatory tariffs or just retaliation generally, because you can retaliate in other ways as well. And there's good political reasons to do that. Are there economic reasons to retaliate, or do we just assume retaliation is kind of a necessary evil type of thing?
Um, there is not in the Canada-U.S. relationship. That is to say, you retaliate when there are no distortions to trade, as there are basically no distortions to trade between our countries, not like China and the U.S. Um, a retaliation as we are doing it is only meant to get the Americans to de-escalate. Because to retaliate is to hurt yourself. You're hurting yourself to hurt them so that they back off. There is no other economic, I mean, I can't see another economic rationale for doing that. So it's really, well, the economic rationale, I guess, is you hurt yourself to prevent a greater amount of pain at some point down the line, and that's justifiable. Unfortunately, or not, that worked in the first Trump term with respect to the steel and aluminum tariffs. So there was retaliation, and the Americans did back off. So there's a track record there of retaliation working in the context of our bilateral relationship. So it does make it likely. Well, we have retaliated, but it was clear that we would retaliate given this history. But also, as you point out, there's a big political dimension to this as well. When when Trump was calling us the 51st state and Governor Trudeau on those things, it created a political situation where it's virtually impossible for any politician, liberal or otherwise, to just turn the other cheek and hope this goes away. So there was a political rationale, which is clear. And the economic rationale is, you take a little bit of bad tasting medicine now in the hope that you get better a little bit later on.
Mhm.
But other than that, if you are convinced, as President Trump is trying to get countries to understand, that retaliation is going to get you nowhere, then it doesn't make sense to retaliate.
I mean, the one consequence of what's happened over the last few months is that Canadians and Canadian politicians have started to reimagine what the new world order will look like. I mean, you raise the prospect of de-escalation, and I suppose the status quo, like pre-November status quo, is one scenario. Other scenarios that politicians have offered up is kind of a more diversified Canadian economy in terms of trade. So, like the export sector kind of largely remains kind of the size that it is, and then we just shift more trade towards Europe. Another scenario is just more self-sufficient kind of economy, kind of more closed economy, something akin to what we had in the 1970s, for example. And another scenario is deeper economic integration because if Trump's objectives are to kind of shift more demand or consumption towards U.S. produced goods. I mean, one way to do that is to raise tariffs and get Americans to buy more U.S. produced goods, or you have some type of customs union where essentially you're shifting Canadian consumption towards U.S. produced goods. So those four scenarios, are they all plausible? I mean, do you think what is the most likely one of those?
I think so putting yourself in President Trump's shoes, the one that makes the most sense is that last one, right? Where you say, listen, we're doubling down in North America. Fine, there's a drug problem, there's a border problem, and we'll deal with that. Be hopeful. But say, listen, we're doubling down. It's Fortress North America. Like we've got free trade amongst our three countries, but America's setting the tariffs against the rest of the world, and you are all going to do the same thing. And that would tick off a few of the boxes I think that President Trump is trying to achieve. Obviously, you know, encourage foreign investment into the U.S. or North America, I suppose, relative to where it is now. It would, check the national security box of say, listen, I want to repatriate some of this stuff because I want to be able to build boats. I don't want to rely on China for pharmaceuticals. I don't want to rely on other countries for rare earths. I don't want to rely on countries for semiconductors. I want to be able to, in the event of a war, produce the things that we need to defend ourselves. So that puts you very clearly in that form, that last camp of strengthen North America together. That is definitely not what President Trump is talking about, but that's the logical. In his shoes, if you're thinking about broad objectives, that might be the most logical one. From a Canadian perspective, listen, we've been trying to diversify trade for a long time, right? We have more trade agreements. We are, I think, the advanced country with the most trade agreements relative to others because we have been trying to diversify for a long time, and it's been very difficult. Now, we haven't had the kick in the butt that we've had in the last several weeks, nor has the rest of the world had the kick in the butt that they've had in the last several weeks. So maybe that creates a bit of an incentive to trade a little bit more outside the North American corridor. Um, but again, the reality is we are deeply integrated with the American economy. Geography matters a tremendous amount for trade. The Americans are right there. They are still the largest economy in the world. They might grow less rapidly than elsewhere, given what they're doing, but they are still the largest economy in the world. So, what has been a tremendous advantage of Canada to be so tightly linked to the U.S. makes it very difficult for us to disentangle at the same time. So, I wouldn't count on a tremendous amount of diversification as we go forward. Perhaps the solution from a Canadian perspective, and I think this is where Canadian policymakers are generally going, is to focus on ways to strengthen Canada and to generate more domestic sources of growth. Um, make investment easier, facilitate investments in the natural resource sector, whether it's oil and gas or whether it's or minerals of various sorts. Think about interprovincial trade barriers differently. Think about the tax regime differently. Think about housing differently. Think about unlocking the economy's potential to try and offset some of the weakness that or the vulnerabilities that come from being associated with the US. And we have the advantage, which is a strange way of thinking about it, but we have the advantage of having underperformed for a long time. So that that there are these buckets or these pockets of things that you can do that are going to meaningfully drive change relative to, say, a country like the Americans, who have been at the forefront of a lot of these things, who are far closer to the frontier than we are. So that marginal change for the Americans is harder relative to ours, where we've got a ton of stuff that we can do to put us on a different path.
And the great thing about an investment-driven expansion in Canada is that investment is a lot more import intensive than consumption, certainly than housing. So you can actually reduce some of those trade imbalances just with a lot of growth in Canada just by shifting some of our activity or more of our activity towards investment-related activity.
Of course,
So
yeah.
that's kind of the best of both worlds. I want to move the conversation a little bit to the Bank of Canada monetary policy. We have a
Mhm.
decision coming this Wednesday. We see a bit of a kind of a coin flip scenario in terms of what the markets and economists are expecting. The central bank has already cut interest rates about 2.25 percentage points since June. So it's been quite an aggressive rate cutting cycle after a very aggressive rate hiking cycle as well. I mean, what do you see them doing this week?
We think they keep rates unchanged, but it's not a slam dunk by any stretch of the imagination. The type of shock that we're experiencing is a really nasty one for central banks, right? It's a shock where it's just a negative supply shock. So you're raising inflation and you're lowering growth. Typically, there's a positive relationship between those two things. So when growth accelerates, inflation accelerates, and when growth slows, inflation slows. In fact, central banks rely on that. You raise interest rates to slow growth, to slow inflation. You cut interest rates to raise growth, to raise inflation. Now you got those two things going in different directions. So it and it's a, so it's a headache. It's a puzzle for central banks. Which is going to be the greater concern, inflation or growth? At this point, we don't know. Clearly, we're reducing our growth forecasts, and they will, I'm sure. But we're also raising our inflation forecasts. And when you look at, for instance, measures of inflation expectations coming out of surveys, Canadians are raising their inflation forecasts quite a bit too, some like 4%. In the US, they're at 6%. So there's clearly some angst about the way forward on inflation, which in our mind, probably kind of tilts them to the holding side for now until there's greater clarity as to which of these dynamics is having more of an impact on the economy. Um, and it's not clear to us that over the year, growth will be the thing that ultimately drives interest rates if tariffs are um, as impactful on prices as we fear them to be. And same thing in the U.S., where the Fed is probably going to have an even harder time cutting rates than the Bank of Canada would because their inflation shock is even larger because their tariffs are on everything. So it's not an environment where a central bank is going to go into any decision and say, yeah, this is a slam dunk for us. Like we know 100% what the playbook is. They haven't played this playbook, or to the extent that they've played the playbook, it was a pandemic era playbook where I think it's safe to say that there's a recognition now that central banks misread the dynamism of inflation early on the post-pandemic surge, which led, of course, to the 5% interest rate, which we've cut back since then. So the most recent historical episode on inflation is one in which central banks kind of got it wrong, and put a little bit more emphasis on the growth side, the inflation side, in that balance, and we're hopeful that the Bank of Canada is going to be a little more cautious this time in terms of um, assessing what might be a temporary upward shock to inflation versus something that's a little more persistent.
Yeah, and they've indicated that even putting aside the issue of stagflation or this stagflationary kind of environment, just they're just not able even to forecast as well as they're hoping kind of what's happening. So that is, and they've announced or they've hinted that they will maybe perhaps not even provide some pinpoint forecast and kind of just focus more on the risks around those forecasts. So. I mean, is that just indicative of how difficult the environment is? You're not just looking at kind of bad outcomes, but you're just not even able to project kind of outcomes at all. I mean, what does that
Yeah.
mean for even policy? I guess that makes you more cautious, presumably.
I think it should make you more cautious. Another way in which this is really difficult for central banks, and so central banks have to be really forward-looking, right? It takes a long time for their policies to have an impact on inflation, 18 to 24 months. So they got these really big, complicated models to help them forecast the next couple of years, to try and make sure they got all the linkages correctly, and that they got as good as possible a sense of where the economy is going to go. And those models, as sophisticated as they are, and Bank of Canada's got them some of the most sophisticated in the world, run by people that are tremendously knowledgeable. Those models are all estimated at a period of time where tariffs on their way down, where we were globalizing. We didn't do the types of shocks, we didn't experience the types of shocks that we're experiencing now, where some person in one country decides, I'm going to do this, and almost break the system. So not only is there uncertainty about what's the president going to decide or do, when is it going to roll it back or not, but you've also got the uncertainty of my models aren't really able, or I don't have enough confidence in my models to tell me what's going to happen going forward, because they're not trained on the types of things that we're living through now. So it's multiple levels of uncertainty for central banks at the present.
And JF, are you worried about inflation? And do you believe, I mean, if we are living in a world of maybe more structural inflation than we've been used to over the past, let's say, generation, do you think that the Bank of Canada's current mandate is still, the inflation target of 2% is still an appropriate mandate? I mean, we are going to have a review next year of the mandate.
I think so. I think you're in a world where it's extremely difficult to change that mandate when, um, to my mind, inflation expectations aren't sufficiently anchored yet. So if you open the door to say, you know what, inflation might be, we're looking at demographic pressures, we're looking at all kinds of things, and it looks like inflation, a better target might be 3%. If you indicate that that's going to be the case, in an environment where people are still unsure where inflation is going to go, you risk making inflation management that much more difficult. So I don't think there's an argument to make at this point in time. I still think that we're slightly behind the curve on where inflation needs to be. I mean, we are, among probably the banks in Canada, those that are a little bit more concerned about inflation than the others, um, for a broad range of reasons, and that suggests to us that the value of caution in the current environment is pretty significant. If there are inflation concerns that now how can I put it this way? If the growth side of the equation starts to matter more from an inflation perspective, then I think the governor's had it right as well. Said, listen, the type of thing that we're going through now, this is the type of thing that is designed for fiscal policy as opposed to central banks. So more reliance on government supports as the economy transitions away from the U.S. or goes through the structural shock of having to transform itself to be, more energy extensive or more accommodating of foreign investment. Um, I think the interesting debate from my perspective is less is it a 2% inflation target thing, but how do monetary and fiscal policies work in an environment where some of their objectives might be across purposes the next year or so?
I think that's a good segue to talk about the Achilles heel of the Canadian economy, which is the productivity crisis. We know that monetary policy is certainly not a tool to solve that problem. Maybe more fiscal policy issue than certainly more issue policy issue than monetary policy. But even then, there are probably limits there as well. You recently put out a report titled "Owning the Podium in Canada's Federal Elections," where you challenged the leaders to present a kind of a compelling long-term vision for the country, and you specifically proposed kind of a metric to gauge success or to provide some accountability. And that would be a target of 2% GDP per capita growth. Just to kind of solve not just the kind of trade disruptions, but this problem predates Trump and has been around for a couple of decades actually. So, I mean, can you just talk a little bit about what you're thinking there, what you're proposing, and why you think kind of this will help a problem that's been with us unresolved now for a very, very long time?
Yeah. I mean, clearly, part of the context is the decline in GDP per capita that we observed over the last few years, which is in large part linked to declining productivity in Canada. Part of the debate around this is, why is investment as low as it is? Why is productivity declining? Who's responsible? How do we fix that stuff? So there's this kind of diffuse accountability on the economic outcome side of things that makes it too easy for governments to, sidestep it and not take it as seriously as they should. Whether that's the federal, provincial, or municipal governments, everybody's got a hand to play in that. So the idea behind, and the idea was quite simply say we thought in governments, or we think the parties should commit to say a 2% GDP per capita objective growth per year over the life of their mandate, or whatever number, one or two or three, whatever number you want to pick, as an accountability mechanism first and foremost. So it forces the platforms, it forces policymakers to make very clear that whatever it is that they do is done in the context of generating this increase in our standard of living. So it's an accountability mechanism that way because you can check in real time. Every quarter we get the GDP per capita numbers. Now they're going to go up and down for various things, but you'll see if you're on track in terms of delivering meaningful change for Canadians, change that actually translates into higher standard of living through investment, through stronger productivity growth. And the other dimension to that is that it squarely, at least from our perspective, it squarely refocuses government policies on those that are going to increase investment. Because at the end of the day, it's very difficult to achieve significant productivity gains if all you're counting on is human capital. You need physical capital with that. You need investment. You need more machinery, more equipment, more computers, more minds. You need all the kinds of things to raise investment, therefore raise productivity. And that's one of the challenges that I think that have been, well, the realities of the last 10 years or so, is that there has been a tremendous amount of focus on the part of government towards call it the accumulation of human capital, right? So things like childcare, dental benefits, a range of things that are designed to raise the value of human capital, which is a perfectly legitimate objective. But nothing really was done on the flip side of that, which is to raise physical capital at the same time. So we need a bit of a pivot. We need a pivot that will see government policies focus much more on the physical capital side of our economy. And that target, which none of the leaders are talking about, of course, because it's way too constraining for them. But that kind of a frame on our economic objectives, how you achieve those, has to filter through the investment side significantly more. So ideally, as you come up with a budget, there's the fiscal question of, okay, what's our deficit, what's our objective, and all those kinds of things. But with this frame of our objective is to raise standard of living by whatever, 1% or 2% a year, every government policy is run through that filter. Does this increase productivity or not in a tangible way? Are we going to be able to say a year from now that these investments, this policy has contributed in a meaningful way to raising the standard of living of Canadians? And that, I think, is something that's been missing. It's too easy for governments to say in every budget, all these things are great, everybody's going to benefit from all these things. They all say that. No, there's not a government out there that puts out a budget that says, we're not sure if this is going to have the impact that we're telling you is going to have. You need something much harder for that. And I think an objective along those lines would help square that circle to some extent, make it more accountable, focus policies more, and probably generate better outcomes than we've been able to generate for ourselves in the last 15, 20 years.
Yeah. And you acknowledge that the scale of the effort to reach this target and 2% per capita GDP growth is very ambitious if you look at the last 10 years or even the last 20 years of GDP per capita growth, which is, if I would be surprised. I haven't done the math, but maybe less than half a percentage point a year. You're talking about the sort of investment required in the order of about 60 billion additional spending per year for capital. How do we get there? Like what, and like how do you generate that sort of increase in capital spending, and what's the role of government here, in your opinion?
Yeah. I mean, ideally, you don't need government for any of this stuff, right? Ideally, our system, there's so many opportunities for profit that, capital goes to where it's needed and investments are made, and, companies are profitable and they're productive and workers are rewarded and all the system works well together. Now, we know that's not what's happened. So, whether it's not clear that it's market failure, but there's clearly something in the system, whether it's the business ecosystem, Canadian entrepreneurs are just more cautious than others. It's debatable. Whether it's the regulatory environment or other things that are just holding things down. So one thought that we had was to see, to the very expensive but tangible way to increase investment, which is to say, listen, we're going through a bit of a crisis. We're thinking about our relationship with the Americans. We know we are uncompetitive. We know we've got a structural challenge on the investment side. We're not sure why, but we know it's there. One option is to say, let's put capital on an unbelievable temporary sale. Say governments commit to matching every dollar that a company spends on investment in capital goods by 25%. So you want to do $1 million investment, here's 250,000 for that. Only if you do it, say, the next 18 months or 24 months. So there's got to be a time limit to it so that businesses understand that it's now or never, because a sale of this magnitude on capital is unlikely to be repeated. But the additional advantage of it helps you from an uncertainty perspective in the short run. It's just a matter of finding businesses are going to invest to some extent. If you make things cheap enough for them and say, listen, I cannot not take advantage of this opportunity, even though I'm not sure of the environment I'm going to operate in. There are incentives that will maybe incent businesses to be a little bit more aggressive in pursuing opportunities. So it's, those kinds of things which haven't been really tried in any significant degree in Canada, other than, say, for instance, battery plants, where we are extremely generous with subsidies, and we know that's worked. But I think we need a little bit of a break the glass moment. Well, I guess we're using the bank head analogy, the break the glass moment of, okay, let's think about stuff that we've never done before, that we're pretty confident is going to work. Now, the challenge, of course, with those things is that they're expensive. But they're expensive only if they work. And if they work, you're also increasing what we call potential output. You increase the productive capacity of the economy, its investment. It's going to have a tangible impact on growth, a lasting impact on growth. And maybe over time, that boost in growth that you get helps pay for the outlays that you're doing in the short run to generate that growth.
I want to end this interview with one easy question. How do we solve the housing problem, JF? I know obviously supply is obviously critical here. And actually, you don't have to kind of go over kind of the need for supply, but I'm curious whether you think that there are any innovations. I mean, given the fact that now, we live in a world where, the average home is, 6 times, let's say, the annual household disposable income. Is there, and that's probably not going to correct anytime soon, even if we manage to increase supply of homes. So in this world where likely, unless we have a collapse in the housing market, likely we will have this affordability issue with us for a long time. Are there anything outside of just increasing supply of homes that we can kind of resolve this, maybe in the mortgage market or some type of financial product innovation that kind of could ease this issue?
Yeah. So the challenge on kind of financial innovation as a way of solving this issue is so long as you've got a supply demand imbalance, any financial innovation that makes it easier for people to buy a place. So say you do a 100-year mortgage or some crazy thing as it exists in some countries. That would drop your principal payment or your mortgage payment a lot. But if that's available to everybody and you still have a shortage of homes, that's just going to get capitalized on the price of a home very quickly. So you're not really effectively increasing affordability in a meaningful way. The only solution out of this is to build more homes. So then the question is, how can you do that? Both parties have platforms on that front. It's increasingly clear from our perspective, and we've actually published some work on this a few weeks ago, where it's clear that the productivity in the construction sector is a major contributor to the lack of affordability in Canada because it's slowed supply response relative to demand. So why is productivity so weak? Why has it been declining so much in the construction sector? Largely a municipal issue, but not exclusively. A number of small firms in Canada in the construction sector. Actually, construction firms in general in Canada are pretty small relative to elsewhere. But it's encouraging in that it's pretty clear that if we find ways to increase productivity in the construction sector meaningfully, you're also going to be dealing with affordability in a meaningful way. So what does that mean? You know, um, Automation. You build more stuff off-site. You reduce or you streamline the approvals process. You streamline the construction supervision process. You provide ways to finance innovation in construction. Um, all those things are all certainly going to pay off in terms of allowing firms to produce more at a lower cost going forward than what we've been able to do. And that's particularly true in an environment where, because homes have become as expensive as they are, they're getting smaller and smaller, right? So more multi-family units, more townhomes, which are more amenable to kind of these large scale innovations, offsite construction techniques than have been the case for, well, forever in Canada. So it's not an intractable solution. The capital will be available, I think, for businesses that want to scale up and be more innovative and productive in that space. I think the market will dictate the winners and losers on that. But at the same time, that's only possible if municipalities get out of the way much more so than they have so far, and that includes on things like development charges as well, which is not a productivity issue, but it is a very significant component in house prices. And, in Toronto, it's something like 30% of the cost of a new place is development charges. So you have to find a way of addressing that, and I think the Liberals have some ideas there, and the Conservatives have some ideas there as well. So I think the nature of the problem is reasonably well understood now. Um, it's just they've got to set up the system to be able to generate those kinds of outcomes. And I'm cautiously hopeful that the leaders get that. Um, Certainly, they speak as though they get it, and it will be a matter for them to pick fights with municipalities in terms of getting them to do what it is that needs to be done for the benefit of all Canadians.
All right. Well, that was Jean-François Perrault, Chief Economist at Scotiabank, sharing insights on navigating Canada's economic challenges. Thank you, JF, for joining us on Hub Dialogues.
Well, thanks, Theo. It was great to have you. Great to talk to you.